is, I've always appreciated Jack's candor on these matters because I agree with him. It doesn't actually have predictive value, but it does have an ability to force a structure. It has an ability to force a structure into your thinking. And whilst it's not predictive in as much as if it was predictive as soon as the cycle low was in, I'd buy it. So therefore, Jack's 100%. It's not going to have that type of predictive value. So if that was ever thought to be the right thing to do, then I think you're mistaking what we've taught in the classroom. We never believe that just because we're reaching a cycle low that you should automatically buy something. We still have a lot of work to do when we reach into those cyclical areas. So Jack's question is very, very interesting. When we think about cycles, it opens the door to a consideration about what cycles actually mean. If they don't have any predictive value, why bother with thinking about the market in a cyclical way? And the reason why is because, as we explained in the classroom on cycles, the average volume on the average candle means that the market maker has average exposures. And if we know that the market maker has average exposures, the idea that those exposures have to go somewhere, have to be aggregated at some stage, or mitigated, in fact, means that there has got to be some sort of cyclical nature to the markets. Now, does that provide us with forecasting abilities? Not exactly, but it provides us with the ability to consider where it might be located, not where it is, but where it might be located. A good example was the oil. So if I was to look at this oil from a cyclical approach, and it's a good example because it's today's example from the US Open. If I look at this from a cyclical approach, what created these markets is a market maker cycle of bids and offers. If we just assume, and we can all agree that that is indeed the case, that a market maker cycle of some description created the bids and the offers in the marketplace. And if that's the case, there must be something to do with the amount of volume that was created and how long it took for those creations to take place. If that is correct, the idea is that by projecting that cycle into the future, just for that one cycle, not 10 times into the future, but just for that cycle, there would be an area that we would expect to contain some buying, because that cycle would be coming to an end, not because the cyclical indicator says it's going to come to an end, but based on the actual traded cycle that the market maker used, which is based around implied volatilities, which does have a very substantial time component. If you believe for 1 second that market makers who price up options do not take the amount of time into consideration, you've obviously never seen the price of an option. You've never investigated the Black-Scholes model. It's got an incredibly big component that involves how long to expiry effectively. So therefore, there has to be a forward projection of something. And that forward projection comes from what? Implied volatilities. How long and how far? And that's the question, isn't it? That's the question that every market maker, whether they be on options or whether they are in the spot markets, every single market maker asks the question, how far and how long? How long is it going to take to go X amount of distance? So if I look at this, how do I approach this from a cyclical point of view? If I'm a seller up here, how do I find the buy trade? I find a cycle that's based around this narrative. So I would start where my sell starts and simply go to where my next sell begins. And I draw a cycle in. Okay, so I start with the sell there and I go to that sell there. Now, what I've got to try and do is I've got to try and put that into a bigger cycle. So what I'm going to simply do in that sense there is I'm going to start thinking that there is, therefore, based on those two cycles, the buy trade should naturally fall into this area here. There should be a buy trade starting to form, right? So this is where the buy trade should form to the right-hand side of this line. And we start looking for that buy trade. If I develop out the cycle to another wavelength, because obviously there's a lot of selling up here, then if I develop out the cycle to another wavelength and I start with exactly the same high, my objective now is to develop out the wavelength cycles. So there's no point in having that wavelength because it means nothing. So I've got to have a cycle low and a cycle high involved in this. So the next cycle low would have to be here. There is no other possible cycle low unless I move to this cycle low here. So if I go to that cycle low to start with, that would start to give us the answers, wouldn't it? So the idea is if this is the cell cycle and it goes in one single sweep, well, that's it. That's the wavelength right there. So for me, the big buy trade is probably going to take place if we get into that trade area there. So whilst it doesn't predict that that is going to happen, it gives me a starting point for a prediction that this is going to be the candle that ends that cyclical analysis. And if that is the case, if that shows up, and it's a big if, it seems that that cycle is still validated at the moment because that's what the implied volatility suggests. If I now go to the right-hand side, I know that there is going to be a buy trade coming up in and around this when this price breaks here. See how we break below the halfway here? I know that this area should therefore be a buy trade for a buy side reversal. So I look in and around this area for a possible buy trade. I can look in and around that area to see if I can find a buy trade reversal. Now, the only reason that that cycle is still considered is because of what happened here. If nothing happened here, like I agreed entirely with Jack at that stage, then we haven't got a cycle that is established. We haven't established any type of cyclical nature of the markets. And I am delighted to agree with Jack that in that case, you just pass through that cycle. You just say, well, it didn't show up. There was no cycling of the markets here. And the reason why there might not be any cycling of the markets there is because of a new driver coming into place. In other words, the Nash equilibrium has fundamentally just dissolved into a pile of mush. But if a buyer does come in here, and that's the question, if a buyer comes in here, it seems to confirm this cycle high and this cycle low. And you can see that that's the biggest volume candle we've got right there, isn't it? It's the biggest volume candle we've got at that stage. So it confirms the cycle low. And if that confirms the cycle low, we know that we want to be looking to buy into this phase here. So when the price crosses there, which is now the bottom of the short-term cycle, we start looking for buying coming in here for that cycle to finish. And we know that if that is the case, that the cycle should complete. If the cycle is still in place, the cycle should complete coming up into this area here. So we start looking in that area for an end of trend. We start looking in that area for liquidity getting grabbed. We start looking in that area for the trade to finish. And the trade does finish. And therefore that cycle comes to an end at that point. Now, do we see any new cycles getting started at that stage? No. So is that cyclical piece of information finished with for the time being? Yes, it is. So what do? You wait for something better to show up now. You wait for something more conclusive to show up now. You start thinking to yourself, where am I going to find some other ideas? And if nothing else shows up, and this is the point I was making to Jack, if nothing else shows up, well, we might as well leave this cycle still visible on the screens, just in case this market moves back into a cyclical market nature. And this is what the Elliott guys failed to accept, that the market sometimes doesn't follow their path of chosen logic, and they just refuse to accept that the cycle doesn't exist. The cycles sometimes don't exist. The cycles simply don't sometimes exist. And if the cycle doesn't exist, you simply move away from it as a predictive tool. You move away from it as an ability to predict that certain volumes at certain prices in certain areas mean something. But when you see something, it's when you've got a blank chart to the right-hand side, it's the beginning of a narrative, perhaps. And if it's the beginning of a narrative, you might say, well, are you not just force-fitting? That was Jack's concept. And you are absolutely just force-fitting. Jack's argument was, the problem with cycles is that you just force fit ultimately what you see, and therefore in the future. But I've just shown you that whilst you're force fitting this cell, and I had no way of predicting that cell perhaps, and whilst I force fitted this cell, and I had no way of predicting that cell perhaps, the fact is that there were two cells at those two prices, and therefore this cycle that took place here must be based on something algorithmic. Because the markets work to maths. The markets work to the bank's liquidity requirements. The markets work to the market makers' volume and liquidity requirements. So if there's something in these two cycles, there's probably going to be something in that cycle low there. Probably. And what we then do is we establish whether there is or whether there isn't. And if there is, and it comes in the form of the biggest volume, we know that the market is now being defined as a cyclical marketplace. And if the market is now being defined as a cyclical marketplace here, I can now look at that and say, well, that's right. So I can hold that cycle in place for the time being, because that's this, if you like, the Black-Scholes model that's now starting to be used for the time being. And it doesn't tell me that this is going to be a buy trade here. It doesn't tell me that it's going to be a buy trade here, but it gives me something to reference. It gives me something to look at. It doesn't tell me that there's going to be a very high probability short sell coming in here, but yet there was a sell coming in at that exact point. Yeah, there was a sell at that exact price point. So when we see that, we start recognizing that that sell there is the same as this buy here, isn't it? It's the last long coming into that top edge. Well, this is the last short coming into that bottom edge. So if the markets have a cyclical component, and they still seem to be exhibiting a cyclical component, and how do you prove that they still are? Because you force fit the narrative. There still are, because by rights there should have been a buy trade here. Was there a buy trade here? Well, there was a buy trade here, wasn't there? We can see that there was a buy trade, so therefore we still believe that the cycle that's being used in terms of the volatility price action that's currently visible still seems to be, in that sense, a possibility that there's going to be a little buy reversal coming in at that price, and then a sell reversal at this price. And that should result in a, according to the implied volatility in terms of the timing of that, in terms of theta, then of course that would suggest that within this cycle, which is now a very, very small cycle, you can see it for yourself, that this cycle is now getting very, very short. You can see that the length of this cycle is a lot longer. This cycle's half the size. So according to that implied volatility, it's probable that the price might not even get any further than this bottom edge here. So, I understand 100% exactly what Jack was saying, and I 100% agree with the idea that the market sometimes falls out of cycles, and I 100% agree that we force fit the cycle to start with, because we've got to force fit, because the cycles start at different times, they change based on information that arrives. But what I do believe is that the market has a cyclical component, simply because if it didn't, the market would cease to exist. If there were no market cycles, there would be no markets. And therefore, if we have an ability to recognize that those cycles are based around implied volatilities, they're based around time cycles, based on theta decay of options, for example, then there must be some sort of regularity to the cycles. And if we can establish, and that's the big if we can establish that cycle in terms of theta, we can establish where these cycles should start and where these cycles should end in the very short term. In the very short term. And if that cycle simply doesn't end there, it's not the right cycle. And you just have to say, well, I haven't seen any change to anything there. I see absolutely nothing to do at that point. I'm just going to pass on this. But if we've predicted If we've looked at and we've developed out the cycles going forward based on this and this, that means we've predicted a buy trade here. So in other words, the prediction of a buy trade there gives us 1 out of 1. The prediction of a buy trade here gives us 2 out of 2. The prediction of a sell trade here gives us 3 out of 3. The prediction of a buy trade here gives us 4 out of 4. And the prediction of a sell trade there gives us 5 out of 5. If that doesn't give us some predictive trade ideas, 5 out of 5, then obviously the cycle's out of line. It's obviously out of line. You say, well, you okay? So you'd have to adjust it. You'd have to look at it and say, well, it doesn't line up. Okay, it's not going to always line up. It's not always going to line up. It's not always going to be the right cycle, because sometimes implied if there was always a right cycle, we would never have any change to option implied volatilities. Well, we know that option implied volatilities change all the time. They change on a minute by minute basis, but on a second by second basis. What we've got to try and do is recognize that the implied volatilities have this cyclical component in terms of theta. So you can see in here, for example, the implied volatility of that move there is a lot smaller than that move there, but because of the time cycle component, the theta time component is still constant in that model. And if we know that the theta time component is still constant, we know that when we got that liquidity, for example, that we are reaching the bottom of both of these cycles. Do we agree? I'm not going to be a seller down here, because I know that if I sell there, I've literally got maybe 1 or 2 candles before a buy comes in. Well, that would have been right. Is it on the tick price when the buy comes in here? No, it's not going to be on the tick price when the buy comes in. But can we all agree that if you get a break through that bottom edge there, and we're reaching what we know for a fact to be at this stage the last 2 candles of the down cycle here, you're never going to be a seller there, are you? You're going to start looking for the possibility that that liquidity is going to be a buyable opportunity based on that arriving theta cycle. Well, you'd have been right. Just the same way as when we ran that liquidity against those little pivots there. It's not the top tick price according to the cycle, but we know from the cycle that it's 1 candle away from the top tick price of a possible cycle reversal. So when we get that liquidity, we're able to take a look at it with the view that it might be a sell trade coming in, just like this trade here. If it still doesn't apply to you, if you still look at it and says, nope, I'm still not happy with it, it's still not something that I'm going to use, I don't have a problem with that. I really don't. You know, whatever you want to use, you decide that that's what you want to use. But what I am looking at here is the ability to, suggest that there is a cyclical nature of every marketplace. And if the market cycles, some of those cycles will be designed by algorithms. And algorithms use straightforward mathematics. And the only things that we can design is based on volatilities, time and price. And that's why when we start drawing out these as simple ideas, it just illuminates the time and price narrative. The volatility is increased, but the time cycle, the frequency of the buying has remained constant. And the reason why the frequency of the buying remains constant is because they're set volumes. Market makers don't have a bottomless pit of money. And therefore we recognize that. And if the cycle starts going out of whack here, it goes out of whack. What do? We start looking if there's a massive buy. Well, you can see the volume's not exactly massive. So I'm not going to start calling this a brand new cycle low and then changing the entire cycle based on what happened here. But obviously the buy came in literally 1 or 2 candles before we knew that the buy was going to come in. So you could claim that as a buy trade when it goes back above here. We're at the cycle low price. So when the price went into here as a Heisman, you know that that's the cycle low before the price goes away up here, because it's already been on the charts before we even started this conversation. And therefore, you're still able to take advantage, even if it's a little bit out, because you're now looking at the market from those terms of where the cycles are. And again, if it doesn't, agree with you theoretically, if it doesn't agree with you mathematically, if you don't understand that element of it, or you don't agree with that element of it, don't use it. I'm a great believer that you use the things that you believe in, because you're then able to take trades with confidence. So, it's like you choosing not to take bottom line fades. It's not because you don't trust bottom line fades, it's just because it doesn't sit well with you. And therefore, I'm happy, delighted for you to wait for a better trade opportunity, which might be the 56 pullback trade. Just because it doesn't sit well with you doesn't mean it's not real, that the cycle doesn't have a value for other people. It's up to you to then choose what it is that has value for you as a trader. And the cycles do change. I'm not sitting here thinking that I'm going to be a buyer into this pullback here. I'm not sitting here thinking I'm going to be a seller here, but it's at least a populated area that I'm now looking at as possibilities. And if the cycles have any type of a future, then you can obviously start adjusting them marginally every time you see a new seller coming in. You can say, well, there was a seller coming in. Why did they sell, and what is their objective? Why was there a short sell at that point? So you can start a brand new analysis of what that seller means. And the best way, of course, is if you're trying to figure out what cycles are, is you pick up on what the frequency is, right? And if you tune into that frequency, that's basically what we're trying to tell you. And I think this is what the agreement was with Jack, is that the current frequency doesn't have to be the future frequency. But if you can tune into what the frequency is that the market maker is on, basically, we can start to recognize where the opportunity might be based on that frequency. And that's it. Based on that frequency, we can start recognizing that the market maker, if they're buying here, there's a very good chance they'll be selling there. It's an observation. It's a frequency observation. And the best way to establish a frequency is to have the 2 points on the frequency, the low point and the high point on a frequency, from here to here, the low point to the high point on a frequency. So if that's the low of the frequency, and that's the high of the frequency, and that's the low of the frequency, there's a high probability that this will be the high of the frequency. In other words, we don't know where the price of these highs or lows are going to be, but we know that they are trading on this frequency, because inside that frequency, remember, between this price and that price, there's the same number of candles as between this price and that price. If there's the same number of candles, there's a high probability that the volumes will be pretty much the same, right? Pretty much the same, not the same, pretty much the same. And therefore, if the volumes are the same, the market maker interest, regardless of how much upside or downside the frequencies have, the volumes inside those candles will average out over time. And therefore, the market making cycle, in terms of that time cycle, has been established. Time brings set volumes. That's the argument for cycles. And therefore, inside of the next cycle, between this cycle here and that cycle here, there is a set amount of volume available for market makers to establish. And the price might go straight down, the price might go straight up. The point is that there is a set amount of volume between these periods. And if the market maker is limited by volume ultimately, which they are, which every trader is, then that volume between that cycle there is probably going to be very similar to the volume between that cycle. The market maker commitment, the market maker edge, the market maker storyline in those areas would be therefore agreeable, and in that sense, we can kind of establish that the cycle should have a volume component, as we would be able to establish. And we can also agree that the cycle should have some sort of directionality. And that's obviously one of, if the market's been dropping down all the time, there's got to be a buy at some stage to aggregate it and take the cycle back up again.